Episode 6. 6 is the age of my oldest son. 6 is also the age when I jumped onto the Pittsburgh Penguins bandwagon. But once I jumped on, I never jumped back off. It's been a great 30-year relationship. Buy and hold, baby. 6 layers in your cerebral cortex and 6 ETFs in my portfolio, which makes no sense whatsoever. What is going on? Beyond MD, episode 6. Here we go. Welcome everyone to episode 6 of the Beyond MD podcast. Today we're going to take a slightly different script, and instead of talking to a financial expert, we are going to be dialing in with two of my former colleagues from Calgary. Both are very successful DIY investors. Now their approaches have some similarities and some differences, but I think there are some pearls to take home for any DIY investor trying to navigate the stock market. But before we get to that, let's just talk about what is going on in the world. Unfortunately, some really bad numbers on the coronavirus front. So at the time of recording, the US has eclipsed 4,000 deaths for the first time in a single day, more than 1,300 deaths in one day in the UK. Ontario is embarking on 4,000 cases in one day. There are protesters who are storming the US Capitol, yet the stock market continues to pull a page from the Honey Badger's book and just doesn't give a shit. Like, look at what's happening. The overall market, S&P 500, is over 3,800 all-time highs. Tesla exceeds $850 US per share. One Bitcoin is $50,000 Canadian. Like, how much longer can this go on? I have no idea. Nobody else really does. But listen, on the coronavirus front, let's just get serious for a second. These are really sad numbers. And I just really hope that we are hitting the worst of it. I really hope that March onwards is going to get better. But I think going forward, all we can do is continue to be good citizens, look after one another, and hope for a smooth vaccine rollout. Now, I do want to hit on a few lessons that I've learned. So the first one, let's go back to March. Crazy bear market, crazy recovery. I did some things well. I did some things poorly. So first thing, I held on for dear life and I didn't sell any of my holdings. So that was success number one. Success number two, I decided to invest. But unfortunately, the way I was investing was somewhat random. Like I was picking up shares of Enbridge, Canadian banks, some defensive stocks, a bit of tech here and there, Coca-Cola, but mostly because these things had dipped and I had them on my buy list. But I wasn't doing things that other really successful investors are doing, and what they were doing was showing a bit more of an understanding and awareness of how our world was changing and thinking about which companies could potentially have a more long-lasting impact and which companies would have a longer growth runway. And so it took a little longer for this to dial in for me, but ultimately it did, and I decided that a few sectors do stand out, and I've been talking a bit more about this on social media. So one of those sectors for me is e-commerce. I think that has changed in the pandemic and beyond, and so what I recently did was I increased my position in Alibaba, and I did this just based on fundamentals, because when I look at Alibaba's e-commerce and cloud computing segments, both are showing double-digit increases in revenue for a solid period of time. Now, as it often happens, you buy shares and then they can tank. And that's what happened to me with Alibaba. And I felt like I was about to be hit by another case of buyer's remorse. But to cope with this, it takes me to lesson number 2. And to cope with it, I resort to a quote that I recently heard on a very cool podcast called the All In Podcast, hosted by Jason Calacanis and Chamath Palihapitiya. And they basically said that if you have a long investment horizon, it's not so important to try and time the market, but what's more important is to tie in the market. And I believe in that. And this takes me back to another experience in my investing lifetime. So April 2019, I decided to invest in NVIDIA. And I did so solely on fundamentals. So NVIDIA, obviously very successful in the gaming industry, but it's more than that. Data management, robotics, artificial intelligence, self-driving cars. The future looks pretty bright for this company. But after I bought the shares, they dipped pretty hard, 30% in 6 months. And as a newbie investor, I was having a hard time dealing with that. And to help me out, I called up a friend, Khalil Jivraj, who you will hear from in the interview, and he gave me some very sage advice. He said, listen, you don't need this money right now. Forget about it. You're in the market. It's a good company. Buy on any dips and just buy and hold for the long term. And I took his advice, and the shares did exactly what he thought they would do. They soared, and particularly so in the pandemic. So with that, let's go right to our interview. Hello, everyone, and welcome to interview number 6 for Beyond MD. This is my second ever 3-person panel, trying something different today with 2 of my former colleagues from Calgary. First in line is Khalil Jivraj, who started the same time as me at Mayfair Diagnostics in 2016. Khalil did his residency in Calgary, fellowship in Stanford. He's a savvy and meticulous investor. His stock picks are better than mine, in my opinion. I'm learning from him all the time. And then we've got Aaron Hall, who started at Mayfair Diagnostics in 2004. Aaron has been investing longer than Khalil and I combined. He is a Jedi on ETFs. So regardless of who you go to, I think there's a lot to learn here for the DIY investor. And with that, gentlemen, welcome to the pod.
Thank you. Thank you for having us.
Aaron, I think we might as well start off with you, because I think your story is interesting, because I think that it sounds like your strategy to investing evolved through time. As I understand that you maybe did once pick stocks, but then over time you came to simplify your approach and landed at a very simple approach in a few ETFs. So maybe you can just talk to us a little bit about that.
Well, I actually didn't ever pick stocks myself per se. I mean, I've been tempted sometimes. But early on, from sort of 99 to 2004, we had our meager savings invested with, in mutual funds through an advisor. I'd always planned to do some research at some point into, what I wanted to do from a financial point of view. And that finally happened in 2004. I spent about 6 months reading books, articles, and debating the merits of various strategies on blogs and internet forums. And then when the evidence overwhelmingly pointed to a passive broad market index approach as the best strategy, that's where I landed. So I came up with about 12 ETFs at that time, and then I rolled those around and reduced it to 7. And then eventually, before actually deploying it, I came down to the 3 ETFs that I now have. And then I cut off ties with the advisor, and the rest is history.
Okay, and maybe you can just touch on briefly, like, which ETFs do you hold today?
So those ETFs are VTI, which covers the US, VXUS, which is an EAFE ETF, and then VCN for Canada.
Okay, and roughly speaking, can you maybe shed some just broad light on, how returns have just fared, broadly speaking, like between the 2 approaches?
Yeah, so from the back in the day with the advisor and the mutual funds, it was actually quite confusing to figure out what the returns were, just because the way they reported them back then is different from now. They usually included your contributions, but after I distilled all that out and tried to figure it out, they weren't very good. I mean, they were well below market, which is typical for funds that are trying to actively sort of figure things out. So these were particularly poor performing mutual funds. Since I went to the passive do-it-yourself approach, our returns have averaged 9.6% for the last 16 years. A big jump from the US, of course. The US has been 11.5% of that. And
yep.
And then the EAFE has kind of lagged a bit, but average about 9.6%, which has been great, sort of way above what we were expecting so far, for sure. Which probably means there's a crash around the corner.
Yeah, I mean, those returns do sound really good, and probably more than I would expect annualized. That's very good. So, Khalil, why don't we move it over to you, because you're a bit of a different animal. I know that you are not averse to risk, but you are meticulous. So we have Aaron's approach, which is a simple approach, and we can see it's stood the test of time. It's worked. And I'll just bring a little bit more context to it. So I listened to a few podcasts recently, and there was a former hedge fund manager, Lars Kroyer, and he was on the Couch Potato podcast. And he said that, listen, there are even professional portfolio managers who at many times are struggling to beat the market. So with all that information, why do you stick to your strategy, which I understand is more focused on individual stocks?
Right. So I'll start off first. Yeah, and I think your podcast is great. I've listened to a few episodes, and it's pretty on the money in terms of what people want to hear. So congratulations to that.
Hey, thanks, man.
I want to first clarify that I think passive investing via ETFs is the best approach. And for everyone, including myself, um, you know, um, basically what you're doing is the average market return is a really, really good return. And, you take a lot of risk off the table. You're investing in the economy. You're investing in population growth. There's no almost thinking. It's very automatic. So I definitely think that is really the best option for all of us to do. From my personal portfolio, I have about 25% of my entire portfolio in ETFs. Majority through Wealthsimple, as you know, in which you just kind of invest a set amount every month, and it's a robo ETF investor. Apart from that, I do have a portfolio of about 40 stocks, which is essentially like a custom ETF. I can't take all the credit for that because my dad's brother, he has been doing the market thing for a while, and he's used this model that's worked and provided good foundation for himself. So I've almost entirely replicated that and added a few things to just round out what my specific interests are in terms of companies. And so just using that, it's a long-term strategy. It's buy and hold. There's no trading. There's no speculating per se. It's buying, in my opinion, the best companies of those individual sectors. And what's interesting is that I was doing some research just for this talk, and I found that the portfolio which I have actually has a similar weighting to what the S&P is. So, in tech, financials, healthcare, travel, hospitality, industrials, it kind of has all of that.
So you mentioned about 40 stocks, and you're a busy guy. We're all busy. Like, you have 2 young kids, just like myself, and I just want to get a sense of, how do you keep up with these companies, and how closely do you follow them? Like, is it as simple as just keeping up with news updates, or do you legitimately tune into all the earnings reports for each of these companies, just to give listeners of kind of what it takes to keep a handle on things? Like, how do you keep up?
The short answer is no. I don't do that. It maybe sounds reckless, but honestly, the key stocks that I have in these particular sectors are like the market leaders. Yes, I do follow news. I'm on CNBC, Market Watch, follow some particular financial people that I like. And so I'm, have an eye and I'm listening to what's happening at all times, but no, I don't follow into the earnings report or little itty bitties and look at all their balance sheets, because I think because we've invested in the biggest companies of those sectors, they're so good. They've been around for a while. They have billions of dollars in revenue. They have billions of dollars in market cap. They're multinational, so you deleverage a lot of your risk there. But but anything can happen, and so you can't just put that on and forget about it and never look at it. Yes, mine needs a bit more attention to make sure that nothing falls apart. But again, I want to clarify for all your listeners that ETFs are a way to go, and I plan on increasing my ETF allocation significantly in the next couple of years.
I was actually hoping you weren't going to say that, and then this was going to erupt into a fist fight. I have actually been about 2/3 individual stocks, one-third ETFs, and I was really banking on this conversation just helping me clarify my thinking, and it kind of already is. So, Aaron, let me just move back to you for a second. So, Khalil just kind of talked about holding good, reputable companies with good balance sheets that are going to be able to withstand different types of stress. And when I look at VTI, so I went back and tracked that ETF. So going from the bottom of the financial crisis, so like March 9th, 2009 until now, the gains in VTI are unbelievable. It seems like, around 500% or so. But if I go and just dissect that ETF and take a look at some of the bigger companies, so like, let's say the 10 biggest ones, going from Apple, Microsoft, Amazon, and going down to Visa and maybe JP Morgan, if one was to only hold those, it seems like the returns there would be significantly higher than the ETF as a whole. And I realize this is a bit of a biased question. There's a lot of selection bias here. I'm looking at a very successful investment period in history. And I'm also looking at, some of the companies that have performed exceptionally well, and they may not show the exact same performance, but I guess why not just take those 10 biggest companies, which seem fairly diverse, instead of the whole ETF? I'm just curious to hear your thoughts.
Yeah, I think that's a great question. And I think it highlights one of the major pitfalls of investing, honestly. So looking at charts and past performance is what we all love to do, and sort of pick where we might have bought and sold. And it can be quite exciting to imagine the possibilities. Especially top performers tempts us into thinking that we can maybe simply pick the next decade's best companies by investing in the ones that have already done really well and got great returns. But there will always be a group of stocks that have trounced the index for a decade, like the current ones that you see in the S&P. The nature of an index is that it's market weighted. The top 10 holdings will often be stocks with several years of market outperformance. So the difficulty or even impossibility is picking those stocks at the beginning of the decade before they outperform. For example, if I took your idea in 2009 and invested in the top stocks of VTI,
yep.
I wouldn't be investing in the stocks that you're mentioning or listing, the ones that are currently in the top 10. Maybe a couple of them, but most of them, no. And I'm just looking up here on the database for ETFs 2009. So ETFDB has top number one stock for 2009 is in the S&P was ExxonMobil. And so,
times have changed. Yeah.
So yeah, exactly. So that's down probably more than 50% since then. So I think that's a good example, and there'll be other financial stocks. I'm sure if we went back even further, we'd find ones that are down more than 90%. So 10 years from now, we'll see different companies in the top 10 of VTI. And those are the ones we should have bought today. But they're hard to pick. Investing in today's winners, the top 10 holdings currently of that index, is likely to result in underperformance if we look back at the previous holdings. So.
Yeah, I think that's a very fair point. And, I recently read, it was an article in the Globe by Scott Barlow. And there was basically a poll that was, conducted for, hedge fund managers. And they said one of the most common mistakes that they see DIY investors make is believing that what worked in the past is going to work in the same fashion in the future. And I think you've just kind of outlined that, and you've given us some good evidence with ExxonMobil, for example. So the ETFs, let's just dive a little bit deeper. I think there's more to maybe picking the right ETF for you than first meets the eye. Looking at things like, assets under management, sector and global diversification, and then also the underlying costs. So maybe you can just take us through a few steps that you take when deciding on which ETF to pursue.
Yeah, sure. So investing can get pretty complex pretty quickly. And so the basic premise of my approach is based on the research that has shown that sort of complexity, stock picking, market timing, and active management tend to not improve returns for the majority of investors, professionals and individual alike. So I selected these 3 ETFs to mimic the world's investable companies by market cap with some Canada bias. So these ETFs are not filled with all the companies in the world, but they include a lot of them, the big ones for sure, and are a good approximation of what we can get at with the world's investable companies by market cap. They have low turnover, low cost, and are passively designed to capture the average return from the world. Now, I realize that average return probably sounds underwhelming and is often a talking point an active manager will use to try to convince people to take a more active approach with them. An active manager, of course, being someone who aims to beat the average return by picking stocks and timing the markets up and downs. But research has established that active management fails to beat the index return most of the time. And the numbers are quite remarkable. Like one study, if I can indulge you for a moment, the active management failed to beat the index 75% of the time in any given year. That's hundreds or thousands of mutual fund managers. Greater than 90% of the time, they failed to beat it over 10 to 15 year periods, and more than 97% of the time when their returns express net of their active fees. So investing is literally one of the only things in life where trying harder results in a worse performance. And I think that's a particularly difficult concept to comprehend for investors who are highly driven and passionate like myself and our fellow physician colleagues.
Yeah, I think that's very well said. And you kind of just alluded to how your ETFs are spread out globally with maybe like a bit of a Canada bias. But I just wanted to get a sense of what is your approach to putting money into those ETFs? Is it the same amount into equivalent amount into each ETF every month, or do you tend to be a more active buyer on the dips, or do you look at, for example, I think VTI right now, and some people don't care about the metrics like price to earnings because we're in a climate where bond yields are low, interest rates are low, but just for numbers, like VTI I think is about 27.7 now compared to VCN at around 19. So is this a time where you're putting more money into VCN? I just want you to maybe talk us through your general approach into how you allocate money into each.
Yeah, so what I do is I have an allocation to each. So basically it works out to 40% VTI, 45% VTI, 40% VXUS, and then 15% Canada. I put a set amount of money according to that allocation into those each year, and I do it the same every time. I usually just do one at a time. So as investable money comes up, I put it in to fill up one, and then I do the next and the next. And I don't pick one or the other for any specific reason. I don't look at the P/E ratio or anything else. It's important for me to distinguish there that that's what I allocate to our investments every year, but that's not the allocation of our portfolio because I don't rebalance. And so a portfolio has a different allocation only because, US has outperformed and other things have lagged. And I'm sure that'll juggle around as the years go on.
So, obviously your selection of ETFs has, global and sector diversification. I just want to touch on diversification a bit more because, in the last several years, there have been new ETFs coming to the market from BlackRock and Vanguard. So like, for example, VEQT. So basically a globally diversified portfolio, of course, maybe with a few, minor cons being maybe a slightly heavier weighting towards Canada than some would like. And obviously a bit of a higher cost than some of the ones that you hold. But I guess, why have you decided to kind of stick to your approach instead of taking like a one-stop shop ETF?
Yeah, that's a great question. I mean, first thing is that those weren't available when I started. Obviously, they were only ETF world was very small in 2005, but now there's a lot more options. But yeah, I look at them all and they're all interesting, but it basically comes down to cost. So, for example, last I checked, some of the single diversified ETF options had management ratios in the neighborhood of 25 basis points or 0.25% or more, and that's 5 times the cost of my portfolio. Which is about 5 basis points. So I know that doesn't sound like much, but on a 1 million portfolio, that's 20 basis points. That's $2,000 a year. And on a bigger portfolio, that can add up to a lot. And you're not taking any more risk to have that extra return.
Yeah, I think that's a totally fair point. So basically, once the portfolio is getting to a certain level, then I think we need to take this stuff into account. I totally agree with you. So, Khalil, I want to just move on to you and ask you a bit more about your approach and your philosophy. So, just to go back to March, when the markets were really dropping, I looking back at that, I really feel like the people who did really well were people who were thinking carefully about, how is our world changing and which companies are really going to have an impact. And admittedly, I don't think that I thought as critically. For me, it was more, I was watching the charts, I was watching things drop, and I said, oh my God, I need to get in now, or I need to put in more. But perhaps I was missing some of that critical thinking. And, to me, you're always a very well thought out guy. So what kind of activity were you doing in March? What kind of stuff were you picking up just for interest?
I mean, everything was down. The one thing, I find that when you have individual stocks, which should be part of an ETF portfolio, in my opinion, I think that you can find similar opportunities, provided you're doing a buy and hold and you're not trading or speculating. You can maybe find some opportunities to build or juice in quotation marks that return of that stock, because maybe for some reason it's down, or there's a market-wide pullback, or maybe there's a sector pullback, or maybe there's a specific company pullback. And maybe at that time you can go in and buy something that is cheaper if you've planned to hold it for a long time. So when things were down, I mean, I did invest in or added a bit more into Amazon, Apple, like the big ones. Square was a big one, just because that the whole cashless society is a big trend that's happening. E-payments, merchant-based payments, that kind of thing. So, and that was just hammered so much that it seemed like an attractive, but I'd already had those stocks in the first place. So it's not like I was like, okay, I'm going to start a new thing and here we go. I'm actually kind of very fixed. I'm not really adding new positions. I'm not really taking any away. I've had these for about 2 years, maybe some fringe things, which we can maybe discuss later, but the lion's share, 90%, 95% are the exact same.
You mentioned one interesting one, and that was Square. And I just want to elaborate on not Square, but we are going to return back to normal at some point. But I think certain parts of our lives and the ways that companies are going to have an impact has changed for some. The growth runway has potentially lengthened for some. And are there some certain sectors like Square's in it's a fintech company, but are there certain sectors that you find really exciting, like in the foreseeable future? Anything catching your eye?
I mean, clean energy and solar seems to be doing very well. And there's actually, you can get ETFs of these sectors. Like I've shared with you that clean energy, ICLN, I'm not sure the exact name of it, but it has basically, it's an ETF of, I think, about 30 basis points is the management fee. And, invest just broadly into mostly American solar or clean energy companies. And that's growing a lot. It seems now with this new Democratic president, they seem to be going up, I think that's, ride sharing was a really big theme until March. It was really big. Lyft and Uber, as came, but obviously their stocks didn't do well out of the gate. And now coming back up, hospitality, Airbnb, I don't have any shares in that, but I mean, this may be a trend. I think that just the cashless society, like 10 years ago, or even 15 years ago, everyone was paying cash. Like it was cool to take out hundreds and pay your dinner with that, right? And now the first thing people do is pick out their phone or...
Yeah, gone are the days when you could walk into a restaurant and drop some dollar bills like a baller. Unfortunately, it just never happens today. But one more point, guys. I just like to know, who do you like to follow in the investing world? I think there's always somebody there for us. And I think for many of us, for the longest time, Warren Buffett was the iconic investor. I mean, so much respect for that guy. But I just feel like over the last few years, his investing approach may have lost some appeal with some followers, just because there's a growing divide between value and technology. And frankly, I couldn't really put a finger on some of his picks this year. Some of them were quite perplexing. No disrespect, but times may be changing. So who do you guys like to follow? I think I'd like to say one thing. Khalil, I think it goes without saying that both you and I do have a bit of a crush on Bill Ackman. I mean, first off, what a savvy and bold investor. Look at the moves he was pulling in March. And let's just be honest. The guy has a great head of hair, which is just universally lacking tonight on the podcast. I mean, look at the three of us. We are totally bald.
But all of us, yeah.
I mean, I am completely jealous. And there's a reason that this podcast is audio only and not video. But seriously, who do you guys like to follow in the investing world?
Aaron, go to you.
Buffett's an interesting character. I think his story is fascinating. If you ever get a chance to read his, it's not an autobiography, but a biography of him called Snowball. It's a fascinating look at his life. But I don't follow anyone specifically. Buffett's really struggled lately, and I think some of the informational asymmetry that he enjoyed early in his career in the 60s, 70s, and 80s has vanished with technology and the internet. So I think he's just struggling along with everyone else now to kind of create alpha and find opportunity.
For me, Yatin, Bill Ackman, and there's actually on CNBC, there's this speaker that comes on. His name is Josh Brown. He's the CEO of Ritholtz Wealth Management in New York City. And he used to be a broker, but now, just has a lot of information and shares a lot of information with people in a very unique writing style. So I'd encourage your listeners to go check out the reformedbroker.com. I mean, he just has good. I shared actually, Aaron, an article with you as well. He just has a nice style of writing, and he's just basically has a good insight and wants to make it easier for us to understand about finances and money and being invested and sticking with the plan.
No, for sure. And I think one I could maybe add to the mix, Chamath Palihapitiya once in a while. I do enjoy his style. It is very refreshing just to see somebody come on to CNBC and just drop some bombs, so I do enjoy that quite a bit. So Aaron, you're the only one of us who invested through the financial crisis, and I just want to get a sense of, how did you handle that period? Because the drop was obviously greater than what we saw now, and you're the one to have gone through it. But how are you acting, and what did you learn through the financial crisis?
Oh boy, yeah, that was that was a breathtaking experience. And it's almost even hard to go back and just remember how gut wrenching it was. We actually were invested through the tech crash in 2000 as well, but the amount was so small, it probably wasn't didn't sort of the stakes were too small to have a big effect. So yeah, our portfolio was substantial heading into 2008 and 100% equity as it is now. So the portfolio lost more than 50% of its value from all-time high to the bottom on March 9th. I had read dozens of books by then and researched extensively, which helped me feel comfortable enough with history of the financial markets, that the previous bears, that long-term it was going to be fine. So I continued to invest on schedule throughout the drop and recovery. As part of our investment strategy, we also use a leverage component at certain predetermined market drops, starting at 20%. And so we keep adding, have kind of tiers, and then 30% down, we had some more, 40%, we had some more. So when it reached 50%, it was just like, I can't believe this is happening. I was almost shaking, ready to put in the next amount, because you wouldn't believe what a sickening feeling it is to put leveraged capital into something that's just dropping over day after day after day. And I always read it was hard, but I didn't really get a good idea of it until it actually started experiencing it. In the long run, it worked out great, obviously, but the headlines were shocking. Just to give you guys an idea of some of the things at that time, like in February, March 2009, everybody hated stocks. Previous active discussions and forums and stuff had all dried up. People seemed to have stopped investing. Imagine investing and hearing things like this every day on the news. It's usually not different, but this time it really is different. That was one. Another one was the system is not just broken, but shattered. The market will never recover to its 2007 highs, let alone even get 30% of the way back. This was every day you're hearing this. If you can't handle any further loss, get out now. Get out, get in cash right now. There's people are screaming this into their podcasts. And then my favorite was, this is the end of capitalism. So, when people were saying, take what you have in your investments, just get it away from the market. But, if I can just indulge you a little further, in the first week of March near the bottom, there were many articles sort of predicting further drop from there, like 50% or more. So it was frightening, but we carried on and everything worked out fine. After that was interesting too. Every step back up, it was called a sucker rally. Everyone said, get into cash. This isn't going to last. So one of the things I once read about bear markets that resonated with me is that it will always feel like the end of the world every time there's a bear, that things are changing in a permanent way that will alter the value of companies forever. And that's true to some degree, and very true for individual companies, because there's always bankruptcies in a bear. But despite that permanent change in some small things, from a grander scale, certainly from a global portfolio point of view, that this change is more subtle when you look at it in retrospect. And we saw some of that happening with a brief pandemic bear this past March, though nothing like what we saw in 2008, 2009. So probably the best part of a low cost passive ETF portfolio is that you don't have to watch this stuff carefully. You don't have to make any decisions. You don't have to panic. You're well diversified. You just can relax and ride it out. You can live your life, see things, do things you want to do, be with people you want to be, and not be anxious. Some of the constituents of the index will go bankrupt. Others will grow to replace them. The investor that gets the average return turns out to be better when the majority of investors, active managers, and advisors, and hedge managers even. So my books and what I learned from them were my foundation, and I recommend to anyone who's considering do-it-yourself investing with a low-cost ETF approach just to read. If someone was to take the 3 ETFs from my portfolio and start investing like that on their own today, there wouldn't be the confidence to stick with it through a bear market like that, or even when it's flat, or when your friend said he's killing it in tech, or when your buddy wants to invest in a strip mall. The portfolio I use is very simple, but that shouldn't be confused for lacking sophistication. Hundreds of hours have gone into it.
Yeah, I think that's really well said. And, why don't we just, expand on that a little bit? Because I wanted to ask both of you for, what is kind of the best resource or book you've kind of come across, one that's really had an impact on you, on the way you approach investing? If there's one that you guys have to share, Aaron, is there one that comes to mind?
Yeah, I mean, there's so many great books, but, if someone's just asking for a single book, I always recommend Winning the Loser's Game by Charlie Ellis. And I picked this one because it covers the basics of market history, passive investing, and covers the danger of trying to outsmart the market. There are several books that have this theme, but this one's the most concise. And I know that lots of people don't have the patience for this stuff or interest to read through a longer brick of a book. And so this one covers the gamut pretty carefully, but quickly.
Okay. Khalil, is there a resource that stands out for you?
For me, a lot of different books that you can reference. Lately, I've just been reading more about kind of the concept of money and wealth and how it ties in with your life, which is not so much on the investment angle, but I think it's also very important to look deeper inside yourself to see, what works for you and your family. What are you willing to risk? What are your goals? What are you willing to do to get there? And so it's kind of more of a holistic type book, and it's called The Psychology of Money by Morgan Housel. And it's a bit more philosophical, but he does talk about different investing strategies, mostly coming back to ETFs, and just the way how it needs to fit into your life.
Okay, so it's like a big picture type of thing.
Yeah.
Quickly, before we get to the end, I want to ask you guys each, what's been your best decision in investing or your biggest winner? Khalil, maybe I'll start with you.
I've been basically, when we finished our fellowship and we got our jobs, that's kind of when I really started investing. So it hasn't been that long for me, maybe like nearing on 3 years.
Yep.
My 4 baggers are like Square, Nvidia, triples are Apple, Amazon, and then doubles are like Uber, Starbucks, Microsoft. And then, those they just stand out, but it's nothing that I did. It wasn't me.
No, we'll give you the credit for Square. Aaron, what about you? Was it the decision to just go to the passive investing? But what was your best decision?
Yeah, I don't have any 4 baggers, that's for sure. But, my biggest winner, honestly, was somehow convincing probably my wife to marry me. Home run for sure, because we are on the same page when it comes to saving, investing, and financial goals. And that makes a huge difference in trying to, make the decisions that we have to make. But strictly from a financial point of view, I would say the best decision was us cutting ties with our advisor to invest ourselves. And as you guys probably know, fees make up a huge component of the active management world. And over a 30 to 35 year time horizon, for a lot of people's investment careers, that can be half of the total value of your portfolio that's been lost to fees. And that's not something that's intuitive, but you have to kind of run it through a spreadsheet to see how bad it can be. And that doesn't even take into account things like turnover, capital gain tax, market impact, broker fees, and the like, and the fact that a lot of them underperform. So, it's a big difference in what a retirement can look like. As far as, really a stock, or I only have the 3. So biggest winner is VTI, and that's just what the market's given me. I'm sure that'll fluctuate and change over time, but the last 16 years have been very kind to USA.
Yeah, absolutely, absolutely. And what about the worst decision or the biggest loser? Just curious. Khalil, do you have one?
Any oil stock.
Yeah.
It's been a losing venture, and like I did it because it was part of a balanced sector weight. It had a role in your fund, right? Like, or in ETF. But my mistake was it was just Canadian. I'd done Suncor and CNRL and CVE, and they've just lost money consistently. And but ties in with what Aaron had said earlier. 2009 Exxon was the biggest, and just the tides change. I'm not disputing the fact that oil is not important. It's not about that. But the Canadian oil companies have underperformed and have a lot of headwinds in the future.
Yeah, no, fair enough. What about yourself, Aaron? Any bad decisions or decisions that you regret that come to mind?
Not like, I mean, VXUS hasn't performed as well. The EFE markets, that's Europe, Asia, Far East. And again, that's just the market. Not a bad decision, I would say, just, what the market's given. So, I'm sure it'll have its day at some point, but maybe, I could say maybe not switching over to an advisor sooner, or switching away from an advisor sooner. That was maybe, something that could have been done in advance of 2005, but that would be about it.
Yeah, it's interesting. I mean, on the last episode, we were talking about the emerging markets and some other countries in the Far East, where some of these countries actually have a demographic tailwind that could bode for some increasing returns in the future. So you never know. A VXUS, I mean, it could outperform down the road. So maybe it's just a matter of time. Why don't we just wrap it up by, I want to give you guys both some time to just provide any advice to our listeners. It could be on investing, just anything general finance. Aaron, we could start with you, and then Khalil will finish up with you.
Sure, yeah. I mean, if I was to give some advice, I would say investing done well should be a slow and painfully boring process. A simple portfolio of broad market, low-cost passive ETFs is the best path to wealth.
Okay, short and sweet. I like it. Yeah, I love it. That's great.
Yeah.
Khalil, how
yeah, and I think just following that, Aaron, I think that we are all capable of doing that. The average person, and the listeners to your podcast are all capable of doing a nice, easy process, and you don't need to use advisors. You can do it yourself with just reading a couple books or a few books, talking to the right people. And I think everyone is capable and able to do that. I guess a couple things I just wanted to share. I think investing is the fun and sexy part. Like, that is, we've worked hard, we've now got here, and now we're really getting into it, and that is fun. I think the mistake is putting the cart before the horse. And, we need to break it up into understanding your financial picture. And then the second part is thinking about how money or wealth impacts your life. So I would propose to your listeners, and I'm sure and you and Aaron have a similar concept in your mind, you must, is it's important to have on a piece of paper spreadsheet your assets to give you an idea of your net worth, because I think that is important to see where you need to go, what you need to do to get there. And the second component I'd encourage your listeners to start is something about your cash flows. So first, going to the assets, I think it's important to have just a simple spreadsheet with 2 or 3 columns: your assets, your long-term, your current assets, which are your stocks, your long-term are your house, your clinic, your cottage, and then your liabilities, your long-term, your mortgages, short-term tax liabilities, visa bills, and you can have them all out. Your personal account, your professional corp, your business, and then you see what that number is at the end, and you can update that every month or every quarter, so roughly this is where I'm at today. It's not to post on Facebook. It's just for you to know specifically where you're at and where you want to go. And then I think also, when you talk about your cash flows, I think, we all work, we have steady jobs, we have a general idea of what we will be earning that year. And you can kind of have that say, this is my cash incoming, these are my accounts. And then, you can have your expenses, like these are my corporate taxes, these are my professional fees, these are my interest payments, et cetera, et cetera. And it's very simple for all your months. And then at the end of the year, you'll know exactly how much cash you will have. And I think with that information, you can make better decisions. You won't get stressed out because you know that in April, you have to pay personal tax if you haven't done installment already. So you've already put in your spreadsheet. It gives you some comfort. It gives you some clarity. You're happy. You know that maybe I won't be able to, buy 10 bottles of champagne that month, but maybe the month after, or whatever the story is. I think if you have an idea of what your foundation is, and it's a personal conversation with your family and your kids or whoever, I think it'll help, and it ties into that FIRE movement, financial independence, retire early. Not saying people want to retire early, but just to have that independence, it's more of a thought process.
Yeah, absolutely. I mean, I think, Khalil, that's a really good advice. And, I in addition, we have a lot in common. First of all, you and I, we're both bald, we're both radiologists. We love finance and we love our spreadsheets, man. I love my spreadsheets. So I just want to ask you a little bit more about that. So are you somebody, you seem to be a goal setter to me. Like you seem to probably have, certain goals you want to reach by a certain time. Is that the case, first of all? And kind of like, how frequently do you kind of assess, hey, I've kind of reached my goal, or I haven't, or this is what I need to do to get there? How frequently are you kind of assessing your financial situation and where you're at?
Yeah. For me, I do it monthly. And that's just, I like it. Like I actually like the accounting and financial mechanics, just to understand. It's just for interest. And I like to do it monthly. I have loose goals. And I think if you just have the end in mind and you have room for error and a margin for safety, and we have long runways, I think we make slow, as Aaron said, slow, measured, practical decisions. I think we can get where we want to be.
All right. I think that's great advice to end it here today. I just want to take the chance now to thank both of you for taking the time to be with us today. And simply just sitting here and talking to both of you, I think it's honestly helped me clarify my approach a little bit. I mean, amidst these volatile markets, especially over the last couple of years, it's very easy to feel lost in investing. And I think you both provided some great information. I know, Khalil, I've relied on you for good advice over the years, and I'm very thankful for that. And Aaron, just to sit here and talk to you, listen to your experience and knowledge, I think it's a real asset. So to both of you, thank you so much.
Thank you for having us.
Thanks for having me.
Disclaimer alert. There were many stocks mentioned on today's show, including by myself. But please, these are not buy or sell recommendations. We are not financial advisors. So please, before you invest in individual stocks, by the way, there's nothing wrong with doing that, but please do your own due diligence. Now back to my 6 ETFs. Like, come on, that is excess, that is overflow. Somebody call a code brown. The same can be accomplished by using 3 ETFs, similar to what Aaron does. Or if you really want to simplify things, then you can go to 2 ETFs or a single globally diversified ETF. It is possible. Now, I do get some interesting messages from time to time, and I'm going to read you one from a friend. And, reading his message, now it seems to me it would have been interesting to include him in the interview today because for sure the gloves would have come off. But anyways, he says, ETFs are in general designed for inexperienced investors who don't want to actively manage their portfolio and don't understand the markets too well. People that understand businesses and the equity markets honestly have no business buying ETFs. Well, I disagree with most of that. I'm not saying I'm right, that's just how I feel about it. So after today's episode, we will be pivoting for a bit away from the stock markets to make sure that we cover other core financial topics, and this is going to include alternative investments, including private equity, because I do think that is very important. But eventually we are going to be hitting on subjects like Bitcoin and cryptocurrency because let's face it, this stuff is becoming mainstream, and it's up to us to keep up with it. So to everyone who's been tuning into the podcast, I really, really appreciate it. And if you like what you're hearing, please feel free to download, subscribe, and spread the word. So until next time, everyone, stay safe and stay savvy.